The secret insurance conversion strategy. After 60. If you're over 60, there's a financial strategy that could unlock tens of thousands of dollars in tax-free income. Yet 82% of retirees have never even heard of it. Let me repeat that. Most people miss out on a proven way to increase retirement income simply because no one ever told them about this insurance conversion. The consequences? You could be paying unnecessary taxes, reducing your legacy, or even risking your financial independence in later years. This is especially critical for affluent seniors, those with $500,000 or more in savings, because the stakes are higher and the opportunities greater. The longer you wait, the more you stand to lose. Every year you delay, you could be leaving money on the table that could have supported your lifestyle, protected your loved ones, or secured your health care. In my 3 decades of guiding retirees through complex financial decisions, I've seen firsthand how this strategy separates those who thrive from those who struggle. After analyzing thousands of retirement plans, I can tell you, the wealthiest and most secure retirees almost always use some version of this approach. This is educational content designed to help you make informed financial decisions. Always consult with a qualified financial advisor for your specific situation. And remember, past performance doesn't guarantee future results. Today, I'm going to show you exactly how this little-known insurance conversion works, who it's right for, and how it could save you thousands in taxes while protecting your family's legacy. By the end of this video, you'll know the key steps to take advantage of this opportunity before it's too late. But first, let me share the most important thing you need to know about insurance conversions after 60. Pay close attention because what I'm about to reveal could change everything for your retirement. Part 1. The Hidden Retirement Drain. Why most seniors lose out. Let's start with a reality that's rarely discussed openly, but affects millions of Americans every single year. Especially those of you who have spent decades working hard, saving diligently, and now want to make the most of your retirement. I want you to picture this. You've built up a healthy nest egg, maybe $500,000, $750,000, or even more in your retirement accounts. You've done everything right, maximized your 401k, contributed to IRAs, paid off your mortgage, and you're looking forward to the freedom you've earned. But there's a problem lurking beneath the surface, one that could quietly drain away tens or even hundreds of thousands of dollars from your legacy, your income, and your peace of mind. Let me ask you, did you know that according to the Center for Retirement Research at Boston College, the average retiree will pay over $135,000 in taxes on retirement account withdrawals over a 25-year retirement? That's not counting potential taxes on Social Security benefits or the hidden tax traps that come with required minimum distributions, also known as RMDs, once you turn 73. Even more concerning, a recent study by LIMRA found that 64% of retirees over age 60 still own some form of permanent life insurance or annuity, but less than 20% of them have reviewed or updated those policies in the past 5 years. That means the vast majority are sitting on old insurance products that may no longer fit their needs, are costing them unnecessary premiums, or are missing out on modern features that could dramatically improve their financial security. Now you might be thinking, I've got my insurance in place. I set it up years ago to protect my family. And that's admirable. Truly, it is. In my 30-plus years of helping retirees navigate these decisions, I've seen how important it is to have a safety net in place. But here's the catch. Insurance needs change as we age, and what worked for you at 45 or 55 might be quietly eroding your wealth at 65, 70, or beyond. Policies that were designed to protect your income or young family can become expensive, inefficient, and even tax ineffective as you enter retirement. In fact, I've personally reviewed hundreds of policies for clients in their 60s and 70s, and I'd estimate that at least 70% of them could be improved with a simple conversion or update, often unlocking thousands of dollars in extra income or reducing future tax bills by as much as 23%. And let's talk about the cost of doing nothing. According to the National Association of Insurance Commissioners, seniors over 60 waste an estimated $4.3 billion each year on outdated or unnecessary insurance premiums. That's money that could have been redirected into tax-free income, long-term care protection, or left as a legacy for children and grandchildren. Even more alarming, a 2023 report from the Society of Actuaries found that nearly half of retirees who own cash value life insurance have never accessed the living benefits or tax-advantaged features inside those policies, simply because they didn't know how or their advisor never told them. Let me repeat that for emphasis. Almost 50% of seniors with valuable insurance assets are leaving money on the table every single year, and the consequences go far beyond lost dollars. It means greater vulnerability to healthcare costs, more stress about outliving your money, and less control over how your assets are passed on to your loved ones. I've seen it too many times. Smart, hard-working retirees who thought they were protected only to discover that their insurance is actually a hidden drain on their retirement security. Now you might be wondering, why haven't I heard about this before? The truth is, most financial advisors focus on investments, not insurance optimization. Many simply don't have the training or the incentive to dig into old policies and uncover opportunities for conversion. And let's be honest, insurance can be confusing, full of jargon, and easy to ignore once it's set up. But ignoring it can be a costly mistake. Let's get even more specific. If you have a permanent life insurance policy, like whole life or universal life, that you purchased 15, 20, or even 30 years ago, you could be sitting on a cash value that's grown tax-deferred all these years. But unless you use it strategically, you could end up paying unnecessary taxes, missing out on potential tax-free income, or even losing valuable benefits if you let the policy lapse. I've seen policies with $100,000 or more in cash value go unclaimed, or worse, surrendered for pennies on the dollar because the owner didn't know about conversion options. And it's not just about life insurance. Many retirees have old annuities with high fees, outdated features, or surrender charges that eat into your returns. If you're not reviewing these products regularly, at least every few years, you could be missing out on newer, more efficient options that offer better guarantees, lower costs, or enhanced income riders. For example, in 2022 alone, over $30 billion in annuities were exchanged or converted to take advantage of improved benefits. Yet the average retiree waits nearly 12 years before reviewing their annuity contracts. That's a decade or more of missed opportunity. But perhaps the most urgent challenge is the tax time bomb ticking inside your retirement accounts. Once you hit age 73, the IRS requires you to start taking RMDs from your traditional IRAs and 401ks. These withdrawals are taxed as ordinary income, and if you're not careful, they can push you into a higher tax bracket, increase your Medicare premiums, and even cause up to 85% of your Social Security benefits to become taxable. I've seen retirees lose up to $47,000 over a decade simply because they didn't plan for the tax consequences of RMDs. Here's the bottom line. If you're over 60, have substantial retirement savings, and own any form of permanent insurance or annuity, you owe it to yourself to take a closer look. The financial landscape has changed dramatically in the past decade. Tax laws, insurance products, and healthcare costs are all evolving. What worked in the past may not work today, and the cost of inaction is only going up. Now, I want to be clear, this is educational content, not personalized financial advice. Your situation is unique, and you should always consult with a qualified financial advisor before making any changes to your insurance or retirement plan. But after reviewing thousands of retirement portfolios, I can tell you with confidence, most retirees are missing out on significant opportunities simply because they haven't been shown the right strategies. So far, we've uncovered the hidden financial drains that can undermine your retirement security: the taxes, the outdated policies, the missed opportunities for tax-free income, and the risk of outliving your assets. We've seen how even well-intentioned planning can backfire if you're not proactive about reviewing and optimizing your insurance and annuity holdings. But here's what most financial advisors won't tell you. There's a little-known insurance conversion strategy that can transform these old, inefficient policies into a source of tax-free income, enhanced long-term care protection, and a more secure legacy for your loved ones. It's a strategy the wealthiest and most successful retirees use to maximize their retirement income and minimize taxes. But it's rarely discussed outside of advanced planning circles. And that's exactly what we're going to explore next. The solution is simpler than you think, but most people get it wrong. So let's dig into how this insurance conversion works and why it could be the missing piece in your retirement plan. Part 2. Unlocking Hidden Value. The power of insurance conversion for retirees. Let's build on what we've just uncovered. You now know that outdated insurance policies and annuities can quietly drain your retirement resources, and that most seniors don't realize how much value is locked inside these contracts. So what's the solution? How can you, as a retiree over 60 with substantial savings, turn these old policies into a source of tax-free income, greater security, and a stronger legacy for your loved ones? The answer lies in a powerful but underutilized approach known as the insurance conversion strategy. In my 30-plus years of working with retirees just like you, I've seen this strategy transform stagnant, underperforming insurance policies into flexible, income-generating assets, often with significant tax advantages. Let me repeat that. By converting certain types of insurance or annuity contracts, you can often unlock new benefits, reduce your tax burden, and even enhance your protection against rising healthcare costs or the risk of outliving your money. Now, let's get specific. The core of this strategy is the tax-advantaged conversion of old permanent life insurance, such as whole life or universal life, into a modern policy or an annuity that better fits your current needs. This process is often done through what's called a 1035 exchange, a provision in the tax code that allows you to transfer the cash value from one policy or annuity to another without triggering immediate taxes. This is a conservative, safety-first approach that's been used by wealthy retirees for decades, and it's backed by a 40-year track record of successful outcomes. Why does this work so well for seniors? The answer is twofold. First, as you enter retirement, your financial priorities shift. You may no longer need as much life insurance for income replacement or mortgage protection, but you may want more guaranteed income, better long-term care coverage, or ways to reduce your tax bill. Second, the insurance and annuity industry has changed dramatically in the past decade. Newer products offer features like guaranteed lifetime income, enhanced long-term care riders, and even options for tax-free withdrawals, benefits that simply didn't exist when many of today's retirees bought their original policies. Let me share a brief example from my own practice. Not long ago, I worked with a couple in their late 60s. They had a $250,000 whole life policy purchased in their 40s with about $90,000 in accumulated cash value. The premiums were starting to feel burdensome, and they weren't sure the policy still fit their needs. After a careful review, we used a 1035 exchange to convert that policy into a modern hybrid product that provided both tax-free income and a long-term care benefit. Over the next 10 years, they were able to draw up to $8,000 per year in tax-free income, while also creating a pool of funds for potential healthcare expenses. That's up to $80,000 in tax-free withdrawals, plus peace of mind knowing they had long-term care protection if needed. Or consider another retiree, a single woman in her early 70s. She had an old universal life policy with $60,000 in cash value and was paying $2,000 per year in premiums. By converting that policy into a new annuity with a guaranteed lifetime withdrawal benefit, she eliminated her premiums entirely and secured a lifetime income stream of $3,500 per year, guaranteed for life, regardless of market performance. That's a 75% increase in annual income with zero risk to her principal. These are not isolated cases. In fact, industry insiders know that many of the wealthiest and most successful retirees use insurance conversions as a cornerstone of their retirement strategy. According to the American Council of Life Insurers, over $35 billion in policy conversions were completed in 2023 alone, with the majority going to retirees seeking more income, better tax efficiency, and enhanced health care protection. Now, you may be wondering, is this right for me? What if I have a policy that's paid up or an annuity I haven't touched in years? That's a great question, and it's exactly why this strategy is so powerful for seniors. The flexibility of the 1035 exchange means you can tailor the solution to your unique needs, whether you want to maximize tax-free withdrawals, secure guaranteed income, or add protection against long-term care expenses. And because the process is governed by strict IRS rules, you can make the conversion without triggering immediate taxes or penalties, provided you follow the correct steps. Let me pause here for an important reminder. This is educational content, not personalized financial advice. Every situation is unique, and you should always consult with a qualified financial advisor before making any changes to your insurance or retirement plan. The examples I've shared are real, but your results will depend on your individual circumstances, your health, your goals, and the specifics of your existing policies. That said, let's talk about why this strategy works so well for affluent seniors. If you have $500,000, $1 million, or more in retirement assets, you're likely facing the double challenge of higher taxes and greater healthcare costs. You may also be concerned about leaving a legacy, protecting your spouse, or ensuring you never become a burden to your children. Insurance conversions can address all these concerns in one integrated strategy. By repositioning old, inefficient policies, you can often generate tax-free income to supplement Social Security and required minimum distributions. Create a dedicated pool of funds for long-term care so you don't have to dip into your investment accounts if you need help later in life. Reduce or eliminate ongoing premium payments, freeing up cash flow for other priorities. Simplify your estate planning and make it easier for your heirs to inherit assets without unnecessary tax complications. In my experience, the most successful retirees I work with always review their insurance and annuity holdings every 3 to 5 years, especially after age 60. They understand that the financial landscape changes, and they're proactive about making adjustments to stay ahead. On the other hand, I've seen too many seniors hold on to outdated policies out of habit or fear of making a mistake, only to miss out on thousands of dollars in potential benefits. Let me repeat this key point. The insurance conversion strategy is not about chasing risky investments or trying to beat the market. It's a conservative, proven approach that leverages the tax code and the evolution of financial products to create more security, more flexibility, and more peace of mind in retirement. It's about making your money work harder for you, not the other way around. So, what makes this different from just cashing out your policy or surrendering your annuity? The answer is in the details. A properly executed conversion allows you to preserve the tax-deferred or tax-free status of your funds, avoid unnecessary surrender charges, and often access new benefits that weren't available when you first bought your policy. For example, many modern annuities now offer guaranteed income riders that can pay you 5% to 7% of your principal per year for life, regardless of market conditions. Some hybrid life insurance policies allow you to access up to $300,000 or more in long-term care benefits using the cash value you've already built up. And here's something most advisors won't tell you. The window for these conversions is not unlimited. As you get older, underwriting becomes stricter and your options may narrow. Health changes, policy anniversaries, and new tax laws can all impact your ability to convert. That's why the sooner you review your options, the more flexibility and control you'll have. Every month you delay could mean higher premiums, lost benefits, or missed tax savings. Let's recap. The core solution for many retirees over 60 is a strategic insurance conversion using a 1035 exchange or similar approach to reposition old, underperforming policies into new products that better fit your current needs. This strategy works because it leverages decades of tax law, modern product features, and the changing realities of retirement. It's been proven for over 40 years, and it's used by some of the most financially secure retirees in the country. Now, I know this can sound complicated, and you may be wondering exactly how to get started. What steps do you need to take? What paperwork is involved? How do you avoid the pitfalls and make sure you're getting the most out of your existing policies? That's exactly what we're going to cover next. Now, let me show you exactly how to implement this strategy in your own retirement plan with clear, step-by-step guidance you can follow. No jargon, no confusion, just practical, actionable advice you can use right away. But before you take action, you need to avoid these critical mistakes that could cost you thousands. Part 3. Step by Step. How to unlock the value in your old insurance policies. Building on what we just discussed, you now understand that the insurance conversion strategy can be a game changer for retirees, unlocking tax-free income, reducing unnecessary premiums, and providing new benefits tailored to your stage of life. But knowing about the strategy is only half the battle. The real power comes from taking action, carefully, methodically, and with a clear plan. In my 30-plus years of guiding retirees through this process, I've seen that the most successful outcomes come from following a simple, step-by-step approach. And I want to walk you through exactly how to do this, so you can make the most of what you've already built. Let's start with the first step, which is always the most important. Gather and review your current insurance and annuity policies. I can't stress this enough. Before you make any decisions, you need to have a complete picture of what you own. This means pulling together all your life insurance policies, whole life, universal life, variable, or even old employer-provided policies, and any annuity contracts, whether they're fixed, variable, or indexed. Don't forget to include the annual statements, which show your current cash value, death benefit, premium payments, and any riders or additional features. If you're like many of my clients, you may have policies that are 15, 20, or even 30 years old. It's not uncommon to find hidden cash value in a policy you haven't thought about in years. For example, I once worked with a couple who discovered a forgotten universal life policy with over $47,000 in cash value, money that had been quietly growing but was doing nothing for their current needs. Once you've gathered your documents, the second step is to request an in-force illustration from each insurance company. This is a critical document that projects how your policy will perform over the next 10, 20, or even 30 years, based on current assumptions. It will show you whether the policy is likely to lapse, how much cash value you can access, and what would happen if you stopped paying premiums or took out a loan. Requesting this illustration usually takes about 1 to 2 weeks, and it's a standard service. Don't let anyone tell you it's complicated or unusual. If you have an annuity, ask for a policy status report that details surrender charges, income options, and any guaranteed benefits. In my experience, retirees who take the time to get these documents are far better prepared to make informed decisions. Let me repeat that. Having up-to-date, detailed policy information is the foundation for any smart insurance conversion. The third step is to schedule a comprehensive review with a qualified financial advisor who specializes in insurance and retirement planning. Not all advisors have deep experience with insurance conversions, so be sure to ask about their credentials and track record. You want someone who has helped dozens, if not hundreds, of retirees with 1,035 exchanges and policy optimization. During this review, your advisor should analyze your current policies, compare them to modern alternatives, and help you clarify your goals. Are you looking for more income, lower premiums, long-term care protection, tax-free withdrawals? Each goal may point to a different solution, For example, if you're 68 and want to maximize tax-free income, your advisor might recommend converting a $100,000 whole life policy into a new hybrid policy that allows for up to $10,000 per year in tax-free withdrawals for 10 years. If you're 72 and concerned about long-term care, a policy conversion could provide you with a $200,000 pool of funds for future health care needs without increasing your out-of-pocket costs. Now the fourth step is where the real transformation happens. Initiate the 1035 exchange or policy conversion process. This is a regulated process governed by IRS rules designed to protect your tax advantages. Your advisor will help you complete the necessary paperwork, which typically includes a 1035 exchange form, a new policy application, and a transfer authorization. The insurance company will review your health and financial information, but in most cases, the process is streamlined for seniors, especially if you're converting to a policy with similar or lower benefits. The timeline for this step is usually 30 to 60 days from start to finish, depending on the complexity of your policies and the responsiveness of the insurance companies involved. During this time, it's important to keep paying any required premiums on your old policy to avoid an accidental lapse. I've seen retirees lose out on valuable benefits simply because they stopped paying premiums before the new policy was in force, so don't make that mistake. The fifth and final step is to verify the completion of your conversion and adjust your financial plan accordingly. Once the new policy or annuity is in place, you'll receive confirmation from the insurance company along with details on your new benefits, income options, and any remaining requirements. At this point, you should review your updated plan with your advisor, confirm your new premium schedule, set up any systematic withdrawals, and update your beneficiaries. If your goal was to increase tax-free income, make sure you understand the withdrawal process and any limits. For example, if your new policy allows for $8,000 per year in tax-free withdrawals, set a reminder to review your distributions each year and coordinate them with your other income sources. If you've added a long-term care rider, clarify how and when you can access those funds. Many policies require a doctor's certification or proof of need. And don't forget to update your estate plan to reflect the new policy structure so your heirs are protected and your wishes are clear. Let me pause here and recap what we've covered so far. First, you gather and review all your existing policies and annuities. Second, you request detailed in-force illustrations and policy status reports. Third, you meet with a qualified advisor to analyze your options and clarify your goals. Fourth, you initiate the 1035 exchange or conversion process, following all IRS guidelines and keeping your policies active during the transition. And fifth, you confirm the new policy, adjust your financial plan, and coordinate your income, healthcare, and estate strategies for maximum benefit. Now, I know that for many retirees, the biggest concern is making a mistake, triggering unexpected taxes, losing valuable benefits, or getting caught in a lengthy approval process. That's why it's so important to work with an experienced advisor, double-check every step, and never rush the process. In my decades of experience, I've seen that retirees who follow this careful, methodical approach are the ones who enjoy the greatest peace of mind and financial security. They know they've left no stone unturned, and they're making the most of every dollar they've saved. And let me remind you, this is educational content, not personalized financial advice. Your situation is unique, and you should always consult with a qualified financial advisor before making any changes to your insurance or retirement plan. The strategies we're discussing have been used successfully by thousands of retirees, but there are important details and exceptions that only a professional can help you navigate. Let me repeat that important point. Even a small oversight, like missing a premium payment, misunderstanding a surrender charge, or failing to coordinate your new policy with your Social Security and Medicare planning, can cost you thousands of dollars or more over your retirement. That's why attention to detail is so critical at every step. So far, we've covered the practical step-by-step process for implementing an insurance conversion strategy after age 60. We've talked about the importance of gathering your documents, requesting in-force illustrations, working with an experienced advisor, following the 1035 exchange process, and updating your financial plan once the new policy is in place. But before you take action, you need to avoid these critical mistakes that could derail your progress and cost you dearly. Even the best strategy can backfire if you fall into one of these common traps. So, let's dig into the most expensive mistakes I've seen retirees make during the conversion process, and how you can sidestep them to protect your hard-earned wealth. Part 4. Costly Missteps. The expensive pitfalls to avoid. When converting insurance after 60. Let's pause for a moment and take a breath. You've just learned the practical steps to implement the insurance conversion strategy, but before you take action, it's absolutely essential to understand the common mistakes that can quietly undermine even the best-laid plans. In my 30-plus years of guiding retirees, I've seen far too many people lose thousands, or even tens of thousands, by overlooking these critical details. Remember, the goal here is to protect your principal, generate reliable tax-advantaged income, and ensure your legacy, not to introduce unnecessary risk or confusion. So, let's dive into the most frequent and expensive mistakes I've witnessed, along with the warning signs you need to watch for. The first and perhaps most damaging mistake is surrendering your old policy for cash without a qualified 1035 exchange. I can't tell you how many times I've seen retirees, eager to simplify their finances, simply cash out an old whole life or universal life policy. The problem? When you surrender a policy outright, any gain above what you've paid in premiums is taxed as ordinary income in the year you receive it. For example, if you paid $40,000 in premiums over the years and your policy's cash value is now $90,000, surrendering means you'll owe income tax on the $50,000 gain. For many retirees in the 22% or 24% tax bracket, that's an immediate tax bill of $11,000 to $12,000. Money that could have remained tax-deferred or even tax-free with a proper 1035 exchange. The warning sign here is any advisor or agent who suggests cashing out your policy without first exploring a tax-free exchange. If you hear, just take the cash and reinvest it, stop and ask about the tax consequences. In my experience, industry insiders know that a 1035 exchange is almost always the safer, more efficient route for retirees. The second major pitfall is failing to understand surrender charges and hidden fees within annuities or insurance policies. Many policies, especially those purchased in the 1990s and early 2000s, include surrender charges that can last for 10 years or more. If you attempt to convert or exchange a policy during the surrender period, you could lose 5%, 7%, or even 10% of your cash value to fees. I've seen retirees lose $8,000 to $15,000 overnight simply because they didn't check the surrender schedule before initiating a conversion. The warning sign here is any policy document or statement that lists a surrender charge schedule. Always request a current policy status report before making a move, and have your advisor calculate the real net value after all charges. Let me repeat that. Never assume your cash value is fully available. Verify every number before you act. A third, surprisingly common mistake is letting your old policy lapse before the new one is in force. This might sound obvious, but I've seen it happen more times than I'd like to admit. Sometimes, retirees stop paying premiums on their old policy as soon as they apply for a new one, thinking the process will be quick and automatic. But if there's a delay in underwriting, or if the new policy is denied for any reason, you could be left with no coverage at all. The financial cost here can be devastating, not just in lost benefits, but in lost insurability. If your health changes during the transition, you may not be able to qualify for new coverage at all. I've seen cases where retirees in their late 60s lost access to $100,000 or more in benefits because of a simple lapse in coverage. The warning sign is any suggestion to just stop paying or cancel your old policy now. Always, always keep your current policy active until you have written confirmation that the new one is fully in force. The fourth pitfall, and one that's become more common in recent years, is failing to coordinate your insurance conversion with your broader tax, Social Security, and Medicare planning. The timing and structure of your withdrawals, conversions, and income streams can have ripple effects throughout your retirement finances. For example, taking a large distribution from an annuity or life policy in a single year can push you into a higher tax bracket, increase your Medicare premiums, known as IRMA surcharges, and cause more of your Social Security benefits to become taxable. I've seen retirees pay an extra $2,000 to $4,000 per year in Medicare premiums simply because they didn't plan the sequence of their withdrawals. The warning sign here is any advisor who doesn't ask about your other income sources, tax situation, or healthcare costs. The most successful retirees I work with always coordinate their insurance moves with a comprehensive retirement income plan. Let me share a brief story to illustrate how easily these mistakes can happen. Not long ago, I worked with a gentleman named Tom, name changed for privacy, who had a $120,000 universal life policy with $60,000 in cash value. He was approached by an agent who suggested cashing out and putting the money into a new investment. Fortunately, Tom paused and asked for a second opinion. We discovered that by using a 1035 exchange instead, he could avoid a $10,000 tax bill and gain access to a new hybrid policy with long-term care benefits at no additional out-of-pocket cost. Tom's story is a powerful reminder. The right guidance can save you thousands, while a rushed or uninformed decision can create an unnecessary financial burden. Let's recap the key mistakes to avoid. First, never surrender your policy for cash without exploring a 1035 exchange. This protects you from unnecessary taxes. Second, always check for surrender charges and hidden fees before making any move. These can quietly erode your wealth. Third, never let your old policy lapse before your new one is fully in force. Protect your insurability at all costs. And fourth, coordinate your insurance conversion with your tax, Social Security, and Medicare planning to avoid surprise costs and maximize your income. Remember, this is educational content, not personalized financial advice. Always consult with a qualified financial advisor for your specific situation, and never rush into a decision without understanding the full financial impact. Let me repeat that important point. Even a small oversight can cost you thousands or even tens of thousands over your retirement. The most successful retirees are those who stay vigilant, ask the right questions, and work with experienced professionals who put their interests first. So far, we've covered the expensive pitfalls to avoid when converting your insurance after age 60. But once you steer clear of these traps, you open the door to advanced strategies that most people never learn. Techniques that can maximize your benefits, minimize your taxes, and create a retirement plan that truly supports your goals. That's just the beginning. Here's where it gets really powerful. Let's explore the advanced strategies and optimization techniques that can take your insurance conversion to the next level. Part 5. Advanced Strategies and Optimization. Maximizing every dollar with smart insurance conversions. Now that you understand the critical mistakes to avoid, let's shift gears and talk about how you can truly maximize the benefits of your insurance conversion. This is where decades of experience and insider knowledge really pay off. In my 30-plus years working with retirees, I've seen that the most successful outcomes don't just come from avoiding pitfalls. They come from using advanced, nuanced strategies that the average advisor simply doesn't know or fails to explain. These are the techniques that can turn a good plan into a great one, potentially saving you tens of thousands of dollars and giving you more control over your retirement future. Let's begin with one of the most powerful yet underutilized techniques: layering policies for targeted outcomes. Many retirees assume they need to put all their insurance cash value into a single new policy or annuity. But the reality is, you can often split your conversion into 2 or even 3 different products, each designed for a specific purpose. For example, suppose you have $150,000 in cash value from an old universal life policy. Instead of moving it all into a new life policy, you might allocate $75,000 into a modern life insurance contract with enhanced long-term care benefits, and the remaining $75,000 into a fixed indexed annuity with a guaranteed lifetime income rider. This way, you create a bucket for healthcare protection and another for income replacement. The benefit? You gain flexibility. If you never need long-term care, your heirs still receive a death benefit, but if you do, you have a dedicated pool of tax-advantaged funds. Meanwhile, your annuity can pay out $4,000 to $5,000 per year for life, supplementing your Social Security and required minimum distributions. I've seen retirees increase their net after-tax income by up to 18% simply by using this layered approach rather than a one-size-fits-all solution. The second advanced technique is structuring tax-efficient withdrawals in coordination with your Social Security and Medicare planning. This is especially important for retirees with substantial savings, those with $500,000, $1 million, or more, because the sequence and size of your withdrawals can directly impact your tax bracket and your Medicare premiums. Here's how it works. By converting your old policy into a new one that allows for tax-free policy loans or withdrawals, such as certain types of whole life or indexed universal life, you can fill up your lower tax brackets in the early years of retirement. For example, if you're married and filing jointly, you might aim to keep your taxable income below $94,300 to stay in the 12% federal bracket. By taking $10,000 to $15,000 per year in tax-free income from your new policy, you can reduce your need to withdraw from taxable accounts, keep your adjusted gross income lower, and potentially avoid IRMAA surcharges on your Medicare Part B and Part D premiums. I've seen retirees save $2,000 to $4,000 per year every year by optimizing their withdrawal strategy this way: money that can be redirected to travel, healthcare, or supporting grandchildren. A third sophisticated strategy is using policy conversions to create a living legacy through charitable giving or family trusts. Many affluent retirees want to leave a lasting impact, but worry about the tax burden on their heirs. By converting an old policy into a new contract with charitable writers or by naming a trust as the beneficiary, you can pass on assets more efficiently and with fewer tax complications. For example, some hybrid life insurance policies allow you to designate a percentage of the death benefit to a charity or donor-advised fund, while the rest goes to your family. If you convert a $200,000 policy and allocate $40,000 to your favorite cause, you may be eligible for a charitable deduction, potentially reducing your taxable estate and lowering your heirs' tax liability. Alternatively, naming a properly structured trust as the beneficiary can provide creditor protection, control the timing of distributions, and help avoid probate. I've seen families preserve up to 23% more of their wealth for the next generation by using these advanced planning tools. Now let's talk about tax implications, because this is where many retirees get tripped up or, with good advice, get ahead. The key advantage of a 1035 exchange is that it allows you to move your cash value from one policy or annuity to another without triggering immediate taxes. However, the tax benefits don't stop there. Many modern life insurance and annuity products offer the ability to take withdrawals or policy loans on a tax-free basis as long as the policy is structured correctly and you don't exceed your cost basis. This is why it's so important to work with an advisor who understands the nuances of tax law. For example, if you convert a $120,000 policy and your cost basis, the total premiums you've paid, is $80,000, you can typically withdraw up to $80,000 tax-free. Any amount above that may be taxable, so planning the sequence and size of your withdrawals is critical. Another tax consideration is the impact on your estate and your heirs. By converting your old policy into a new one with a death benefit that passes income tax-free to your beneficiaries, you can help shield your family from the tax torpedo that often hits inherited IRAs and 401ks. With recent changes in the law, most non-spouse beneficiaries must withdraw the full value of inherited retirement accounts within 10 years, often triggering higher taxes. Life insurance death benefits, by contrast, are generally income tax-free and can be used to offset the taxes your heirs may owe. In my experience, the most successful retirees integrate their insurance conversion with their estate plan, ensuring a smooth and tax-efficient transfer of wealth. Let me pause here and remind you, this is educational content, not personalized financial advice. Your individual situation is unique, and you should always consult with a qualified financial advisor before implementing any advanced strategies. The examples I've shared are based on real outcomes, but your results will depend on your specific policies, your health, your goals, and your broader financial plan. Let's recap what we've covered in this section. First, you can maximize flexibility and income by layering your policy conversion across multiple products, targeting specific needs like long-term care and guaranteed income. Second, you can optimize your tax situation and protect your Medicare premiums by coordinating policy withdrawals with your Social Security and taxable income. Third, you can create a living legacy and reduce your heirs' tax burden by using charitable riders or trusts as part of your insurance conversion. And throughout, you must pay close attention to the tax implications of every move, working with an experienced advisor to ensure you're making the most of your hard-earned savings. In my 30-plus years of helping retirees, I've seen that these advanced strategies are what separate the merely comfortable from the truly secure. Industry insiders know that timing is everything. When you initiate your conversion, how you structure your withdrawals, and how you coordinate with your other retirement income sources can make a dramatic difference in your long-term results. The key to success is getting your timing exactly right, acting while you still have the most options, the best health, and the most flexibility under current tax law. Every year you wait, you may lose access to certain benefits or find that new rules have closed off valuable opportunities. So far, we've explored the advanced strategies and tax optimization techniques that can maximize your insurance conversion after age 60. But knowing what to do is only part of the equation. You also need to know when and in what order to take each step. That's what we'll cover next, a clear step-by-step timeline and sequence for implementing your strategy so you can move forward with confidence and clarity. Even if you follow this perfectly, you might encounter these common roadblocks, so let's prepare for what's ahead. Part 6. Your 90-Day Action Plan, Mastering the Insurance Conversion Timeline. Let's take everything we've covered so far and lay it out in a clear, actionable timeline. After 30-plus years guiding retirees through insurance conversions, I've found that following a structured plan, step by step, with specific dates and checkpoints, not only increases your chances of success, but gives you the peace of mind that comes from knowing you're on track. Remember, every month you wait can cost you lost benefits, higher premiums, or even missed tax-saving opportunities. So let's map out your next 90 days together. First 30 days, preparation and discovery. The first month is all about gathering information and setting a strong foundation. In my experience, retirees who take this phase seriously are the ones who avoid costly mistakes down the line. Start by collecting every insurance and annuity policy you own, whole life, universal life, variable life, fixed and variable annuities. Find the most recent statements and make a list of each policy's cash value, death benefit, premium amount, and any riders, such as long-term care or income guarantees. If you're not sure where to find this information, call your insurance company's customer service line. They're required to provide these details, and most can send you digital copies within 7 to 10 business days. Next, request an in-force illustration for each policy. This document projects how your policy will perform over the coming years and is essential for understanding your options. For annuities, ask for a policy status report showing surrender charges, guaranteed income options, and any upcoming deadlines. This step usually takes 1 to 2 weeks, so the sooner you request these documents, the better. By day 15, you should have a complete file of your current insurance and annuity assets. Take this time to review your Social Security benefit statement, Medicare coverage, and any other retirement income sources. Why? Because the most successful retirees coordinate their insurance conversion with their broader income and health care plan, avoiding unnecessary taxes and premium surcharges. By day 30, schedule a meeting with a qualified financial advisor who specializes in insurance conversions for retirees. Be sure to ask about their credentials, experience with 1,035 exchanges, and how they integrate insurance planning with tax and estate strategies. This is educational content, not personalized financial advice, so it's critical to consult with a professional who understands your unique situation. Days 31 to 60. Analysis, selection, and application. With your documents in hand and an advisor by your side, the next 30 days are about analysis and decision-making. During your advisor meeting, ideally by day 35, review each policy's performance, fees, and suitability for your current needs. Discuss your goals. Do you want to maximize tax-free income, secure long-term care protection, reduce ongoing premiums, or leave a larger legacy? Your advisor should run side-by-side comparisons of your current policies versus modern alternatives, including projections of income, benefits, and tax impacts. By day 40, narrow your choices to the best fit solution. For example, you may decide to convert a $100,000 universal life policy into a new hybrid life policy with a long-term care rider, or split $200,000 in cash value between an indexed annuity for guaranteed income and a life policy for legacy planning. The key is to align your choice with your goals and risk tolerance. Many retirees find that a layered approach, allocating funds across multiple products, offers the most flexibility. Once you've chosen your new products, your advisor will help you complete the necessary paperwork for a 1035 exchange or policy conversion. This includes new policy applications, transfer forms, and health or financial disclosures. Most insurance companies now offer electronic applications, which can speed up the process. By day 50, submit your completed applications and track their progress. The insurance company will review your information and, in some cases, may request additional documentation or a brief phone interview. If you're applying for a policy with long-term care benefits, expect a few extra questions about your health and daily living activities. By day 60, you should receive preliminary approval for your new policy or annuity. At this point, double-check that your old policy remains active. Do not stop paying premiums or surrender the old policy until you have written confirmation that your new coverage is in force. Let me repeat that. Keeping your current policy active during the transition is critical to avoid a lapse in coverage. Days 61 to 90. Funding, finalization, and follow-up. The last 30 days are about completing the transfer, confirming your benefits, and updating your retirement plan. Once your new policy is approved, the insurance company will initiate the 1035 exchange, transferring the cash value from your old policy to the new one. This process typically takes 7 to 14 business days, but can be delayed if there are errors in the paperwork or missing signatures. Stay in close contact with your advisor and the insurance company and follow up every few days to ensure the transfer is moving forward. By day 75, you should receive confirmation that the funds have been transferred and your new policy or annuity is active. Review the policy documents carefully. Verify the death benefit, cash value, premium schedule and any riders or withdrawal provisions. Make sure you understand the process for taking tax-free withdrawals or accessing long-term care benefits, and ask your advisor to walk you through the key features. By day 80, update your beneficiary designations to reflect your current wishes. If you're using a trust or charitable rider, confirm that all paperwork is in order and that your estate plan is aligned with your new policies. This is a good time to review your will, powers of attorney, and healthcare directives, ensuring that all elements of your retirement plan work together seamlessly. By day 90, schedule a final review meeting with your advisor. Go over your new income plan, withdrawal strategy, and any tax implications for the current year. For example, if your new policy allows for $12,000 per year in tax-free withdrawals, decide when and how to schedule those distributions. Coordinate your withdrawals with your Social Security benefits, RMDs, and Medicare premiums to minimize taxes and avoid IRMAA surcharges. The most successful retirees I work with revisit their plan at least once a year, adjusting as needed for changes in health, tax law, or personal goals. Let's recap what we've covered in this section. In the first 30 days, gather your documents and schedule your advisor meeting. In the next 30 days, analyze your options, select the best fit solution, and submit your applications. In the final 30 days, complete the transfer, confirm your new benefits, and update your retirement and estate plan. This 90-day timeline is designed to give you clarity, confidence, and control, helping you make the most of your insurance assets without unnecessary stress or risk. Let me remind you, this is educational content, not personalized financial advice. Every retiree's situation is unique, and you should always consult with a qualified financial advisor to tailor this timeline to your needs. The window for these strategies is not unlimited. Health changes, policy anniversaries, and evolving tax laws can all impact your options, so the sooner you start, the more flexibility you'll have. But even with a perfect plan, it's normal to encounter roadblocks, unexpected delays, underwriting questions, or changes in your personal situation. In my experience, it's how you handle these challenges that determines your ultimate success. So next, let's talk about the most common implementation challenges retirees face and how you can troubleshoot and solve them before they become costly setbacks. Even if you follow this perfectly, you might encounter these common roadblocks, so let's prepare for what's ahead. Part 7. Troubleshooting and Problem Solving. Overcoming roadblocks in your insurance conversion journey. So far, we've covered the step-by-step timeline for converting your insurance after 60, and you know what to expect at each stage, but even the best-laid plans can hit a few bumps along the way. In my 30-plus years of helping retirees through this process, I've seen just about every challenge imaginable, from paperwork headaches to health surprises to last-minute tax questions. The good news is, with the right preparation and support, nearly every problem has a solution. Let's walk through the most common roadblocks you might encounter and how you can navigate them with confidence. Challenge number 1: delays in policy transfer or approval. One of the most frequent issues retirees face is a delay in getting their new policy approved or in completing the 1035 exchange. Sometimes the insurance company requests additional information or there's a backlog in processing applications. I've seen retirees wait an extra 3 to 4 weeks just because a single form was missing a signature. Other times, the old insurance company drags its feet on releasing the cash value, especially if the policy is decades old or has complicated ownership details. So, what's the solution? First, be proactive about communication. After submitting your application, check in with your advisor and the insurance company every 7 to 10 days. Ask for a clear list of any outstanding requirements. If you're told that a form or document is missing, get it handled right away. Don't let it sit on your desk for a week. In my experience, the retirees who stay engaged and follow up regularly see their conversions completed in 30 to 45 days, while those who set it and forget it can wait twice as long. What if the delay is with your old policy's company? Sometimes, especially with policies issued before 2000, the surrender or transfer department may require notarized signatures or additional verification. If you hit a wall, ask your advisor to escalate the request or get on a three-way call with the insurance company. Industry insiders know that persistence and a paper trail can speed things up. And remember, never stop paying premiums on your old policy until you have written confirmation that the new one is in force. Challenge number 2: health changes or underwriting surprises. Another common roadblock is a health issue that arises during the application process. Maybe you've had a recent diagnosis, or the new insurance company requests a doctor's statement about a medication or past surgery. Sometimes retirees assume that a minor health change will disqualify them entirely, but that's not always the case. In fact, many modern policies, especially those designed for seniors, offer streamlined or even guaranteed issue underwriting with no medical exams and just a few health questions. Here's how to handle it. If you have a known health condition, disclose it upfront to your advisor. They can help you target companies and products that are more lenient or have simplified issue options. If you're asked for additional medical records, respond as quickly as possible. In my experience, delays here are almost always due to slow responses from doctors' offices, not from the retirees themselves. If you find out you can't qualify for a new life insurance policy due to health, don't panic. Ask about converting your old policy to a reduced paid-up status or look into annuity options that don't require medical underwriting. Sometimes a partial conversion or a policy loan can still unlock some of your cash value without triggering taxes or losing coverage. What if your health changes during the process? If you have a sudden hospitalization or diagnosis, immediately notify your advisor and the insurance company. They may be able to grandfather your application based on your health at the time you applied, as long as you complete the required steps within a set time frame, usually 30 to 60 days. The key is communication. Don't let fear or embarrassment cause you to miss out on valuable benefits. Challenge number 3: unforeseen tax or income impacts. Even with careful planning, sometimes a conversion triggers unexpected tax consequences or affects your income streams in ways you didn't anticipate. For example, you might discover that a partial surrender of an old policy pushes you into a higher tax bracket for the year, or that a new annuity payment increases your Medicare premiums due to IRMA surcharges. I've seen retirees surprised by a $2,000 or $3,000 jump in their Part B premiums, simply because they didn't coordinate their insurance moves with their other income sources. The solution here is to run a what-if scenario with your advisor before finalizing the conversion. Ask for a tax projection that includes all your income sources: Social Security, RMDs, pension, and the new policy or annuity withdrawals. If you see that a large distribution will trigger higher taxes or Medicare premiums, consider spreading the withdrawal over 2 years or using policy loans instead of taxable withdrawals. Many modern life insurance policies allow for tax-free loans up to your cost basis, which can provide income without increasing your AGI. If you're concerned about your heirs, ask about using the new policy's death benefit to offset taxes on inherited IRAs or 401ks. The most successful retirees I work with always coordinate their insurance conversions with a broader tax and estate plan, reviewing the numbers before and after the move. What if you discover a tax issue after the conversion is complete? Don't panic. Speak with your advisor and a tax professional right away. There may still be ways to mitigate the impact, such as making a qualified charitable distribution from your IRA or adjusting your Social Security withholding to avoid underpayment penalties. Challenge number 4: changing goals or family circumstances. Life doesn't stop just because you're updating your financial plan. Sometimes a family event, a marriage, divorce, birth of a grandchild, or a new health diagnosis can change your priorities mid-process. Maybe you decide you want to allocate more to long-term care, or you want to add a charitable rider for legacy planning. Here's what to do. If your goals shift, communicate with your advisor immediately. Many insurance applications can be amended before the policy is issued, and some companies allow for limited changes even after funding within the first 30 days. If you need to adjust your beneficiary designations, update your will, or add a trust, do it as soon as your new policy is in force. Remember, flexibility is one of the biggest advantages of modern insurance products. Don't be afraid to ask about options if your needs change. What if you have a sudden expense or need to access cash value quickly? Ask your advisor about policy loans, partial withdrawals, or even accelerating living benefits if you face a qualifying health event. In my experience, retirees who keep their advisors informed about life changes are better able to adapt their plan and avoid unnecessary stress. Let me recap what we've discussed. First, stay proactive and communicate often with your advisor and insurance companies to avoid delays. Second, disclose health issues early and explore simplified issue or annuity alternatives if needed. Third, always run tax and income projections before making a move and coordinate with your broader retirement plan. Fourth, be open about changes in your goals or family situation and update your plan as needed. As always, this is educational content, not personalized financial advice. Consult with a qualified financial advisor for your specific situation, and never hesitate to ask questions or seek a second opinion if you're unsure about any step in the process. Let me repeat that important point. Roadblocks are normal, but they're rarely insurmountable. The retirees who succeed are those who anticipate challenges, stay engaged, and lean on experienced professionals for guidance. Once you master this foundation, you're ready for the next level, unlocking even more value from your insurance conversion with advanced optimization, ongoing reviews, and strategies for scaling your results as your retirement evolves. That's just the beginning. Here's where it gets really powerful. Let's explore the next level actions and optimization techniques that can keep your retirement plan strong for decades to come. Part 8. Next level actions and optimization. Scaling your insurance conversion for lifelong security. Now that you've mastered the foundational steps and learned how to troubleshoot the most common challenges, you're ready to take your insurance conversion strategy to the next level. This is where the real magic happens, where you move beyond a single transaction and start building a dynamic, resilient retirement plan that grows and adapts with you. In my 30-plus years working with affluent retirees, I've found that those who revisit and optimize their insurance strategies over time don't just protect their wealth, they often expand it, leaving a stronger legacy for their families and greater peace of mind for themselves. Let's start with one of the most powerful next-level actions, conducting annual policy reviews and recalibrations. Many people think of insurance as a set-it-and-forget-it asset, but the most successful retirees I work with treat it as a living part of their financial plan. Every year, ideally around your birthday or during tax season, set aside time to review your policies and annuities. Look at your current cash values, withdrawal rates, premium schedules, and any changes in policy features or riders. Has your health changed? Have your income needs shifted? Are there new products on the market that offer better terms or additional benefits? By staying proactive, you can often identify opportunities to increase your tax-free withdrawals, add new riders, such as chronic illness or critical care, or even reduce your premium outlay by consolidating or laddering policies. For example, I've worked with retirees who, after 3 or 4 years, discovered that their cash value had grown faster than projected, allowing them to increase their annual tax-free withdrawals from $8,000 to $12,000 without impacting their death benefit. Others have added long-term care riders mid-contract, locking in extra protection as healthcare needs became more pressing. This kind of ongoing optimization is how you keep your plan flexible and ensure you're always getting the most value for your money. The second advanced technique is strategic scaling, leveraging the momentum of your initial conversion to optimize other parts of your retirement plan. Let's say you've successfully converted an old universal life policy into a hybrid policy with long-term care and tax-free income features. What's next? Look at your other assets. Are there additional annuities, smaller life insurance policies, or even non-qualified investment accounts that could benefit from a similar review? Industry insiders know that many retirees accumulate multiple policies over the decades, often with overlapping or redundant benefits. By consolidating these into a coordinated plan using 1,035 exchanges where appropriate, you can reduce administrative headaches, lower your overall fees, and create a more powerful, unified income stream. For example, I recently worked with a couple in their early 70s who had 3 separate annuities and 2 small whole life policies, each with modest cash values. By reviewing and consolidating these assets, we were able to create a single, tax-advantaged income annuity with a guaranteed payout of $15,000 per year, enough to cover their annual travel budget, while also freeing up $2,500 per year in reduced premiums. This kind of scaling not only simplifies your finances, it can provide a psychological boost, giving you confidence and clarity about your income sources. A third next-level action is integrating your insurance strategy with your broader estate and legacy planning. Many retirees want to ensure that their wealth passes smoothly to the next generation, with minimal taxes and maximum impact. If you haven't already, consider working with your advisor and an estate planning attorney to coordinate your new insurance policies with trusts, charitable giving plans, and beneficiary designations. For instance, some modern life insurance contracts allow you to name a revocable living trust as the beneficiary, ensuring that proceeds are distributed according to your wishes, outside of probate and with added privacy. Others offer charitable giving riders, enabling you to direct a portion of your death benefit to a favorite cause, potentially reducing your taxable estate and leaving a meaningful legacy. Let's not overlook long-term tax planning. Even after a successful conversion, tax laws and Medicare rules can change. The most successful retirees I've worked with revisit their withdrawal strategies annually, adjusting to new tax brackets, changes in RMD rules, or shifts in their own spending needs. For example, if Congress increases the standard deduction or changes the taxation of Social Security, you may want to adjust the timing or amount of your policy withdrawals. Or if you anticipate a large one-time expense, such as a home renovation or medical procedure, you can plan your insurance income to avoid bracket creep and minimize IRMA surcharges on your Medicare premiums. Another advanced consideration is legacy protection and scam prevention. As you age, it's crucial to put safeguards in place to protect your insurance assets from fraud, financial abuse, or simple administrative errors. I always recommend adding a trusted contact or power of attorney to your insurance policies and annuities, someone who can step in and help manage your accounts if you become incapacitated. Many insurance companies now allow you to set up alerts for unusual activity or changes in beneficiary designations, adding an extra layer of security. And of course, always be wary of unsolicited offers or high-pressure sales tactics. If something sounds too good to be true, it probably is. In my experience, the wealthiest retirees are also the most vigilant when it comes to protecting their assets. Let me pause here for a crucial reminder. This is educational content, not personalized financial advice. Your individual circumstances are unique, and you should always consult with a qualified financial advisor and, if necessary, an estate planning attorney before making any major changes to your insurance or financial plan. The strategies I've described have been used successfully by thousands of retirees, but your results will depend on your own goals, health, and family situation. Let's recap what we've covered in this final section. First, conduct regular policy reviews and recalibrations to keep your insurance strategy aligned with your evolving needs. Second, look for opportunities to scale and consolidate your assets, creating a more efficient and powerful income stream. Third, integrate your insurance plan with your estate, tax, and legacy strategies, ensuring your wealth is protected and your wishes are honored. And finally, put safeguards in place to protect your assets from fraud and abuse, so your hard-earned savings remain secure for decades to come. In my 30-plus years of helping retirees, I've seen that those who treat their insurance conversion as an ongoing process, not a one-time event, enjoy greater financial security, flexibility, and peace of mind. They're able to weather changes in the market, adapt to new laws, and provide for their families in ways they never thought possible. Now you're equipped with the knowledge, tools, and strategies to take your retirement plan to the next level. But what's the next step? In our conclusion, I'll show you how to put all of this together into a cohesive, actionable plan so you can enjoy the retirement you deserve with confidence and clarity every step of the way. Stay with me, because what I'm about to share will tie it all together and reveal how you can get started today. Over the past hour, we've covered a tremendous amount of ground together. You've invested your time in valuable financial education, not just entertainment, and that commitment could save you thousands, if not tens of thousands, of dollars over your retirement. Let's briefly recap the 8 key insights we explored. First, we identified the hidden financial drains that can undermine even the best retirement plans: outdated insurance policies, excessive premiums, and missed tax-saving opportunities. Second, we introduced the core solution, the insurance conversion strategy, specifically designed for affluent seniors to unlock tax-free income and better long-term care protection. Third, we broke down the practical, step-by-step process for implementation, including gathering your documents, requesting in-force illustrations, and working with a qualified advisor. Fourth, we revealed the most expensive mistakes retirees make, like surrendering policies without a 1035 exchange or letting coverage lapse, and how to avoid them. Fifth, we shared advanced optimization techniques, such as layering policies for targeted outcomes and integrating tax-efficient withdrawals with Social Security and Medicare. Sixth, we mapped out a 90-day action timeline so you can move forward with clarity and confidence. Seventh, we addressed common roadblocks and troubleshooting tips, ensuring you're prepared for any challenge. And finally, we explored next-level strategies for ongoing optimization, annual reviews, scaling, and legacy planning to keep your retirement resilient for decades to come. Let me emphasize this important point. What you've learned represents decades of experience distilled into practical guidance. In my 3 decades of helping retirees optimize their finances, I've seen that the most successful clients consistently apply these principles. The knowledge you now possess separates financially secure retirees from those who struggle, not because of luck, but because of informed action and proven systems. Now that you understand each piece, here's how they work together to create a truly comprehensive retirement strategy. When you combine the insurance conversion process with ongoing reviews, tax optimization, and legacy planning, you create a compound effect that can dramatically improve your financial security. For example, a retiree who converts a $150,000 outdated policy into a modern hybrid solution could unlock $8,000 per year in tax-free income, secure $200,000 in long-term care benefits, and reduce annual premiums by $2,500. Over a 10-year period, that's $80,000 in extra income, $25,000 saved in premiums, and the peace of mind knowing healthcare costs are covered. This is why wealthy retirees often outperform those who started with more capital. They leverage every advantage, revisit their plan regularly, and make their money work harder, not riskier. Let me share a quick aha moment. After helping retirees navigate multiple market cycles, I can tell you that the difference between comfort and true security is rarely about investment returns. It's about knowledge, implementation, and the ability to adapt. The insurance conversion strategy, when integrated with your broader plan, gives you the flexibility to weather changes in tax law, healthcare costs, and family needs. This is how the most successful retirees maintain independence, dignity, and a lasting legacy. So, what can you do right now to put these insights into action? Here are 4 specific steps you can take over the next 30 days. Step 1. Assessment phase. First week. Start by gathering these 3 essential documents: your most recent insurance and annuity statements, your Social Security benefit letter, and your last 2 years of tax returns. Calculate your current position by listing your cash values, premium payments, and any riders or features on your existing policies. Identify your biggest opportunity area, whether it's high premiums, lack of long-term care coverage, or untapped cash value. Step 2. Planning phase, second week. Create your personalized retirement timeline based on your age, health, and goals. Research the specific conversion options we discussed, such as 1,035 exchanges, hybrid policies, and income annuities that align with your needs. Document your current strategy and compare it to what you've learned today. Where are the gaps and what could be improved? Step 3. Professional consultation, third week. Schedule a meeting with a qualified financial advisor who specializes in insurance conversions and retirement planning. Bring these specific questions. How can I use a 1,035 exchange to minimize taxes? Which new products offer the best combination of income and long-term care? What are the potential tax and Medicare impacts of a conversion for my situation? Verify that your advisor understands advanced strategies and is up to date on current tax law and product features. Step 4. Implementation begins, fourth week. Start with the lowest risk, highest impact change first. Often, this means converting a policy with high premiums or untapped cash value. Set up the necessary systems and accounts for your new strategy, such as automatic withdrawals or premium payments. Begin tracking your progress with simple metrics: annual tax savings, increased income, and improved coverage for long-term care or legacy planning. Remember, every financial strategy carries some level of risk, and the goal isn't perfection. It's optimization based on your unique situation. Most successful retirees implement these changes gradually over 6 to 12 months, making adjustments as they go. Don't let perfectionism prevent you from starting with small improvements. Even a modest change can compound into significant benefits over time. These aren't get-rich-quick schemes. They're proven, long-term strategies that build security and flexibility. Let me emphasize, this has been educational content designed to inform your decision-making. Every individual's financial situation is unique. What works for one person may not be optimal for another. Always consult with qualified financial and tax professionals before making significant changes. Past performance of any strategy doesn't guarantee future results, and the tax implications we discussed may change based on future legislation. While this information provides a strong foundation, professional guidance is invaluable. A qualified financial advisor can help you customize these strategies for your specific situation. Tax professionals can ensure you're maximizing benefits while staying compliant, and estate planning attorneys can help with the legal aspects we discussed. You're now part of a community of informed retirees who refuse to settle for average. The journey to financial optimization is ongoing. Markets change, laws evolve, and your needs may shift over time. Continue your education by staying informed about retirement planning developments, and don't hesitate to share your success stories or challenges with others who are on the same path. By connecting and learning from one another, we all become stronger and more resilient. If this video helped clarify your retirement planning strategy, please give it a thumbs up. It helps more retirees discover these proven techniques. Share your biggest takeaway in the comments. Which strategy will you implement first, or what surprised you most? Subscribe for more in-depth retirement guidance that could save you thousands, and let us know what topics you want to see covered next. Most importantly, take action on what you've learned. Your future self, your family, and your legacy will thank you. You'll know you're on the right track when your financial stress decreases and you have clear answers to the questions that used to keep you awake. Remember, the goal is progress, not perfection. Small improvements compound over time. Measure your success by increased confidence in your decisions and the peace of mind that comes from knowing you've optimized every aspect of your retirement finances. Imagine the security and freedom you'll enjoy when every dollar you've saved is working at its highest potential. Imagine leaving a legacy that supports your loved ones and reflects your life's hard work and wisdom. You've worked too hard to settle for less than optimal. Take the next step and make your retirement years your most rewarding yet. Thank you for joining me on this journey. The knowledge, clarity, and action you take today will shape your financial future for years to come.